Time now for an in-depth look at the market news this afternoon, and for that I'm joined on the line by Dr. Jun-sok, professor of economics at the Catholic University of Korea. Professor Yang, good afternoon. Thanks for coming on today.
Happy to be here.
Well, let's start with this World Economic Outlook from the IMF, which lowers the IMF's growth forecast this year for the American economy by a full 1%, now to 6% for the year. That's the biggest cut for any of the G7 countries, but the IMF is sticking with its forecast for Korea. Tell us about that and what you take away from this report.
Okay, well, the global growth rate hasn't changed all that much. The IMF lowered the global growth rate by 0.1%, and it pointed out the problems between advanced countries and developing countries. Advanced countries, even though they pulled down some of the growth rates on this particular projection, they're still doing very well. Their vaccination rates are increasing fairly rapidly. And the economy is returning to normal, but a lot of emerging economies, a lot of developing economies, they're having trouble getting vaccines. They're still undergoing very high rates of infection for coronavirus. So there's two sides. One, the developing country side is not really getting into recovery at all, while the advanced countries are recovering fairly rapidly, but not as quickly as the IMF thought that it would be at the beginning of the year. And the part of that reason is because the advanced countries are hitting supply bottlenecks. In order to produce goods, they need a lot of intermediate goods and raw materials, especially from developing countries. And because of the corona situation in the developing countries, they're not making their deliveries on time or even promptly. There's a lot of variations on how these supplies of raw materials and the intermediate parts are going to factories around the world, and that is slowing down supply, which is the biggest reason, I believe, that the growth rates of advanced countries are being pulled down. If we read interviews with factory owners and businessmen in the advanced countries, they keep mentioning that the supply shortfalls, as well as the rise in prices due to these supply shortfalls, are the major reasons why their companies are having problems meeting the demand from consumers in the advanced countries. And these bottlenecks have become worse than expected. And the problems that we have with transportation, lack of ships to deliver these products, are also having a major effect on supply chains. And that's basically, I think, the reason why they pulled down the growth rates for the advanced countries.
Indeed, Professor, and on Wall Street overnight, we saw the declines in stocks continue, all three main indices down for a third session in a row, though Tuesday's decline wasn't nearly as big as some we've seen recently. Earnings coming up and also minutes from the Fed's latest meeting. What's the story in the global markets?
Okay, well, after the market soaring on Thursday because the U.S. Congress reached an agreement on debt deadlines, the stock market has been declining, as you said, for the last 3 days. There has been increasing fear of inflation and tapering, partially because of the supply bottlenecks that I just talked about. Three Fed members, Vice Chair Clarenda, and two regional Fed presidents have said that the Fed is probably ready to start tapering as early as November. And that seems to be making the markets very nervous. And they've also mentioned that while the growth is slowing and while the last U.S. job report wasn't as high as they wanted it to, well, unemployment has fallen down pretty much. Right now, the unemployment rate has reached 4.8% last month, and originally the Fed expected the unemployment rate to be 4.8% at the end of the year. So even with the recent slowing down of growth, they're doing better than what the Fed expected at the beginning of the year, and inflation has become higher and longer than what the Fed expected. The Chairman Powell has testified in Congress that their expectations on inflation being very short-term turned out to be wrong, and inflation will be higher and longer than what the Fed has expected. Of course, that is more case to start tapering earlier and start raising the rates earlier, and that is basically making the markets very nervous.
Well, here in Korea today, a bit of a rebound actually in the markets. The Kospi staying above that 2,900-point mark thanks to strength in tech shares. Tell us about the domestic market.
Okay, well, Korea has gotten a lot of very good news in the last couple of days about exports and the earnings report. Samsung and Hynix reported that they have historically high revenues for the third quarter. Samsung's revenues were 73 trillion won. Hynix revenues were 15.8 trillion won. As I said, this was the highest on record. Samsung's operating profits went up by 28%. And not only semiconductors, but smartphones, which had been somewhat problematic in the last couple of years, also did very well. Their foldable phones seem to be selling very well. Hynix operating profits went up by 200%. So that is very good news for people who are investing in these stocks. And then Korean exports for the first 10 days of the October, again, it went up a lot higher than most people expected. Exports to September was historically high. And the Chinese exports, which we had been worried because, well, they're having a shortage of electricity that may impact on Chinese exports, which may in turn impact on Korean exports of intermediate goods. Well, apparently Chinese exports went up 28% in September despite the shortage of electricity. So that means good news for Korea in the near future. And the Bank of Korea's decision to delay the interest rate rise is, I think, also playing a part of it. So that is basically accounting for why the Kospi rose by 0.96% today. Kosdaq also rising by 1.42%, basically for similar reasons.
And finally, Professor, employment in Korea, the data for September show the biggest increase in more than 7 years in the number of people employed, an increase of about 670,000 from a year earlier. What do you make of these numbers?
Okay, well, this year's September numbers look so good because last year's September numbers look so bad. So a lot of this is, I think, a bounce back effect. So I've been comparing this year's numbers with 2019 numbers. And if we compare the 2021 September numbers to 2019 September numbers, in terms of absolute numbers, 2021 has reached slightly beyond 2019 levels. In September 2021, we had 27.7 million jobs, and that's slightly higher than 2019's 27.4 million jobs. So in terms of number of jobs, we can legitimately say that we've returned to more or less pre-corona levels. But if we look at quality of the jobs, then it's still problematic. Full-time workers, 2021 is slightly less than 2019. And part-time jobs, they're slightly higher than where it was in 2019. Number of people who are temporarily laid off, 2021 is slightly higher than 2019. So in terms of quality of jobs, we are still not back to the pre-corona levels. And if you look at the age breakdown, people in their 30s and 40s and 50s, their employment rate in 2021 is less than 2019. This is very concerning because these are prime age jobs. They're also heads of households. So the employment rate being lower than where it was in 2019 is concerning. Then where the job increase come from? It came from people in their 20s and 60s. And the problem with jobs for these people in their 20s and 60s is that they're mostly government financed jobs. So it does show that a lot of job growth is depending on government budget, government spending, and this is not sustainable in the long run.
Got it, Professor. All right, thank you for breaking all that down for us. We always appreciate it. We appreciate you coming on today.
Thank you.